A business can be profitable on paper and still run into serious trouble when cash becomes tight. A customer pays late, equipment suddenly breaks, sales slow down, or an unexpected bill arrives, and the business still needs to pay employees, suppliers, rent, taxes, and lenders. In this video, you will learn how the business cash buffer rule works, how much cash you may need, and how to calculate a practical buffer for your own business. Number 1. Understand the cash buffer. Imagine a small consulting company normally spends $20,000 every month. Suddenly, two major clients delay their payments by 30 days. Revenue has been earned, but the expected cash has not reached the company's bank account. The company still needs to pay salaries, rent, software subscriptions, insurance, utilities, and other bills. Without extra cash available, the owner may need to delay payments, borrow money, or use expensive short-term credit. A cash buffer is money intentionally kept available for situations like this. It is not money the business expects to spend during normal operations. It exists to provide financial protection when cash flow becomes temporarily weaker. For example, if the company keeps $60,000 available while normal monthly cash expenses are $20,000, it has approximately 3 months of operating expenses protected as a cash buffer. That does not mean the company should stop managing receivables or controlling expenses. The buffer is a backup system, not a replacement for strong cash flow management. Businesses should still collect invoices quickly and manage spending carefully. Think of the buffer as financial breathing room. If sales unexpectedly fall for 1 month, the company does not immediately need to cut important expenses or take the first loan offered simply because cash is temporarily tight. The practical rule is simple: keep enough accessible cash to handle realistic disruptions without damaging normal business operations. The exact amount depends on monthly expenses, revenue stability, payment timing, debt obligations, and overall business risk. Number 2. Calculate monthly cash needs. Imagine a retail business spends $15,000 on payroll, $8,000 on inventory, $4,000 on rent, and $3,000 on utilities, marketing, insurance, taxes, and other regular monthly obligations. The owner should not calculate the cash buffer using revenue. If monthly revenue is $50,000, that does not mean the business needs a $50,000 monthly buffer. The calculation should focus primarily on necessary cash outflows. Start by identifying expenses that must continue even when sales temporarily decline. Payroll, rent, essential supplier payments, insurance, utilities, debt payments, taxes, software, and critical operating expenses should usually receive the most attention. Suppose the business determines that $30,000 must leave the bank account during a normal month. A 1-month cash buffer would therefore be approximately $30,000 under this simplified calculation. A 3-month buffer would require approximately $90,000. A 6-month buffer would require approximately $180,000. These numbers create starting points rather than universal targets for every business. You can make the calculation more practical by separating essential expenses from optional spending. Advertising experiments, non-essential travel, renovations, and discretionary purchases may be reduced during a crisis, while payroll and rent may be difficult to reduce immediately. The goal is to answer one important question: how much cash would this business realistically need to continue operating if incoming cash suddenly became weaker? Once you know that number, you can build the buffer around actual needs. Number 3. Choose the right buffer size. Imagine two businesses each spend $40,000 per month. The first has hundreds of customers paying immediately. The second depends on 3 large clients that normally pay invoices 60 days after receiving them. Even though both companies have identical monthly expenses, they should not automatically maintain identical cash buffers. The second business has greater collection, concentration, and timing risk because losing or delaying one major customer could significantly affect available cash. A business with stable recurring revenue, predictable expenses, low debt, and fast customer payments may operate comfortably with a smaller buffer. Its future cash inflows are generally easier to estimate and manage. A seasonal business may need significantly more protection. Imagine a tourism company earning most of its annual revenue during summer. Cash generated during strong months may need to support expenses during several slower months. Businesses with unpredictable sales, high fixed expenses, slow-paying customers, expensive inventory, or significant debt payments may also benefit from larger buffers because they have less flexibility when unexpected cash flow problems appear. Instead of blindly following one universal number, consider a range. Some businesses may target roughly 3 months of essential cash expenses, while more volatile businesses may decide that 4, 5, or 6 months provides better protection. Your buffer should reflect the financial risk of your business. Ask how quickly revenue could fall, how long customers take to pay, which expenses can be reduced, and how difficult emergency financing would be to obtain. Number 4. Build the buffer gradually. Imagine a business needs a $90,000 cash buffer, but currently has only $20,000 available. Trying to save the remaining $70,000 immediately could create unnecessary pressure on normal operations. Instead, the owner can build the buffer gradually. For example, the business could transfer a fixed percentage of monthly cash collections into a separate reserve account until the desired cash buffer is reached. Suppose the company generates $10,000 of available cash after essential expenses during a strong month. Instead of spending the entire amount on expansion, the owner might move $4,000 into the cash buffer. The same approach can work with unusually strong sales months. If a seasonal business generates significantly more cash during its peak period, part of that extra cash can strengthen the reserve before slower months arrive. Another option is setting a minimum cash balance. For example, management might decide that available cash should never intentionally fall below $60,000 unless there is a genuine emergency or planned strategic reason. The business should also avoid treating the buffer as extra spending money. New furniture, unnecessary equipment upgrades, additional office space, or optional projects should not automatically be funded from emergency cash simply because money is available. Building a strong buffer may take several months or longer. What matters is creating a consistent system. Regular contributions can gradually turn a financially vulnerable business into one that can handle unexpected cash problems with greater flexibility. Number 5. Use and rebuild it correctly. Imagine a company keeps $100,000 as its cash buffer. A major customer unexpectedly delays a large payment, while payroll, rent, supplier invoices, and loan payments are all due before that customer pays. Using part of the buffer in this situation can make sense. The reserve allows the company to continue meeting important obligations without immediately taking expensive debt or damaging relationships with employees, suppliers, or lenders. Now imagine the owner wants to use $30,000 from the same buffer for a luxury office renovation. That is very different. The expense is planned and discretionary rather than an unexpected cash flow problem. A useful rule is to define acceptable uses before problems happen. Unexpected revenue interruptions, emergency repairs, temporary collection delays, critical supplier payments, and unavoidable operating expenses may qualify depending on the company's financial policy. After using the buffer, rebuilding it should become a financial priority. If the reserve falls from $100,000 to $70,000, future excess cash can gradually restore the missing $30,000. Management should also review the target regularly. If monthly essential expenses increase from $20,000 to $30,000, an old $60,000 reserve has changed from 3 months of protection to only 2 months. The business cash buffer rule is ultimately about resilience. Keep enough accessible cash to survive realistic disruptions. Calculate the target using essential cash needs, adjust it for business risk, and rebuild the reserve whenever you use it. If you found this video helpful, like, share, and subscribe to the channel for more practical business finance videos. Thank you for watching.